Good morning, everybody. It's Tuesday, May 19th, and this is what is on today's agenda. Oil drops as President Trump says there will be no attack on Iran today, at least. Korean stocks fall as Seagate puts memory in focus. And UK assets brace for Labour data. Oh, and the fiscal politics.
So, King Kospi, the crown is slipping, at least for now, down 2.4%. The losses had been heavier earlier in the session on that sell-off in the chip sector, as Anna was saying. That's rippled across the Asian markets as well. Brent crude then currently down 1.6% at around $110 a barrel on the Trump lines around Iran. European stock futures, though, pointing to gains of 0.2%. Is today the day when actually Europe benefits by not having a lot of exposure to the chip space, pointing higher by a little over 0.1%. The countdown to the opening trade starts right now.
Tuesday morning, good morning. A few interesting things happening out there, and Anna and Tom have just talked about them, but let's dig into them in a little bit more depth. What is fascinating this morning is that oil's down, but stocks are down as well. US futures are lower. Now, recently, what you've seen is oil down, stocks up. We're not seeing that, but that points us maybe towards the chip story that Tom was talking about. We'll come back to that in a moment. And the other interesting thing is that as the Cosby goes down, Europe goes up. Is Europe the anti-Cosby kind of trade at the moment? And I think Tom's point is well made around all of that. So I think there's an interesting sort of churn happening within the markets. But basically what we're looking at this morning is oil lower. This on comments coming through from President Trump indicating that he has been asked by a number of GCC countries not to attack Iran again, to restart the war, to end the ceasefire. Does that hold? Does that hold for long? The implication here is that we are getting ready for another round of conflict, Anna, and you wonder kind of how long this oil drop can last for.
Yes, yeah. Do you focus on the fact that there's no attack today, or do you focus on the fact that there was an attack planned, according to President Trump, and maybe it comes in days, if it comes at all? It's interesting. Also, we've got this other story that the US Treasury is extending the waiver on Russian energy as well, and so clearly mindful of that's for another 30 days. So they're removing the sanctions there for another 30 days. So clearly mindful of the fact that we need more oil in the system, we need more energy to get into the system. But stocks did still move on some of the Iran lines yesterday. We are still as much as we want to move on to AI and all the rest, certainly European stocks, to your point, moving yesterday on some of these conflicting headlines around what was coming out of the Middle East.
Because the case could be made that the status quo, as things stand, can't stand, that one way or another something has to happen, either a deal or a return to military conflict. So how the markets price that? Are the bond markets now pricing in a return to conflict? The bond markets are again selling off, yields up, and you're seeing that across the Japanese space. There's some economic data out of Japan as well that ties in to what is happening there in terms of pricing in potentially that hike from the BOJ in, of course, June. But the uncertainty, therefore, that continues. It does seem like the status quo can't hold in terms of what is happening around the Straits of Hormuz. So which side do we go on, and how much is being priced in by these markets as inflation risks rise?
And on the bond market, there are people now who are starting to say, is there value here? Goldman Sachs saying, looking at the 30-year at 5.13%, some emerging measure of value, but they are cautious. So that is a sort of sense of where the conversation is right now, because a lot of people have been getting out of bonds. Barclays, PGIM, all pretty negative on bonds just over the last couple of days.
The other key theme for us today is what's been happening. So a second straight day of losses in the semiconductor space. Interestingly, so the Philly stock index fell. The Philadelphia Semiconductor Index fell yesterday again for a second straight day. You had companies like Micron under pressure, Marvel under pressure. But interestingly, the software stocks actually performed to the upside. So that dynamic has switched, at least in the last 24 hours or so in the US. You saw the read across, of course, to the Asian markets, the Kospi, but also Taiwan under pressure as well. And this is something you've been highlighting, Guy, is concerns about whether or not the demand for chips is cyclical or not. And it's the Seagate CEO suggesting in comments at an event that maybe he thinks that is indeed cyclical, suggesting that he doesn't want to build out too many factories in case that demand starts to ebb. And that seems to be one of the catalysts for the sell-off.
OK, explain this to me, because I'm feeling thick this morning and I don't understand what is happening here. Why did Seagate go down on this? Because it strikes me that what he said at this JP Morgan conference should be good for investors. Basically, he's saying we're not going to fall into the trap of building too much capacity. We're going to focus on higher density drives. We're not going to fall into that trap once again. I would have thought that would be positive, not negative.
That supports the bottom line. If you're thinking about the profits, then maybe that supports the bottom line. But does it suggest a lack of conviction that this is a change to a more structural growth story, and maybe people had been buying into a structural growth story. I don't know. I'm also feeling slightly slow on this particular subject, but it certainly weighed on Seagate, but it weighed on the whole sector. Yeah. So it wasn't even just that company, and he's kind of said it before. He said it in a Bloomberg News interview not that long ago.
He's reiterated the point. Meanwhile, Blackstone and Google teaming up. They seem to think that the infrastructure demand will continue and for years ahead because they have a challenge. They have a proposition at least to invest, potentially, if you could include margin and leverage, about $25 billion to build out data centres to kind of compete with the likes of CoreWeave. And you're hearing from executives that they are implementing AI and there is a job cost to this, whether in the banking space or in the tech space. If you look at Standard Chartered or Meta, both announcing adjustments to headcount on the back of the AI investments.
Let's talk about the UK, shall we, a little bit? We've got some data just breaking on the UK. And, at the margin, this looks weaker for the UK labour market. So if we look at private earnings, excluding bonuses, 3 months year on year, we've dropped down from 3.2% to 3%. That's the extent of the wage rise. And that is a little below the estimate of 3.1. And then we look at the unemployment rate over 3 months. And that is now at 5%, ticking up from 4.9. This is in keeping with what Bloomberg Economics was saying ahead of these numbers, that they are expecting a tick up in unemployment, and that will weigh on Labour's ability to demand more wages, and so that's for them the reason why we won't get quite so many hikes from the Bank of England. But the UK story is complex right now. Yeah,
there's an inflation problem, and there's a labour market problem,
and there's a politics problem.
There is definitely is there a problem? I don't know whether there's a problem yet. Andy Burnham trying to sound like he understands the bond market concerns yesterday, saying all the right things. It sounds a bit like Starmer to me, trying to say as little as possible to upset the apple cart in advance of an election, which is quite consequential.
But do you? Fine.
Yes. From his team.
Yeah.
The question is, do you believe him? Because basically, if you watch the video of him walking around, he's talking about anti-Thatcherism. He's talking about reversing the supply-side reform that Thatcher delivered. He's talking about nationalisation. He's talking about demand-side reform. He's talking about building lots of council houses. He's talking about all of these things which are going to cost money. So therefore, I don't understand how you can stick with the fiscal rules and deliver all of what he is talking about, this kind of anti-Thatcher rhetoric that reverses, 40 years of supply-side reform that the UK had?
So, therefore, how much commitment does he have to the tax pledges that were made by this government in the manifesto, which takes us back to that question about how far away from the manifesto he goes and where that takes the politics. That's certainly... And actually, the IMF warning just yesterday, warning, stick to the fiscal rules, as you'd expect, but also warning about the UK's ability to take more tax rises. So that's another interesting dynamic to watch.
Yeah, the short-term reaction, of course, was that gilt yields were lower on the back of this news and the pound was slightly stronger. We'll see how gilts react today.
Still quite elevated.
Yes.
So, yes, down a little bit. So the bond market sort of said, thank you very much, we'll take that for now, but there are still significant questions. Mathias Cormann, the OECD Secretary-General, is going to be joining us very shortly. Alexandra Jackson, Rathbones Asset Management Director of Equities, is going to be joining us. We'll have a big focus there on what UK assets look like in this age of turbulence that we're seeing in British politics. And Miguel Stilwell de Andrade, EDP's CEO, is going to be joining us. So a fascinating conversation about kind of what is happening with the solar story, the renewable story, inertial rotation, all those great sort of things that we need to be focusing on a little bit later on, Tom.
Here's what else we are watching throughout the day. At 9:10 UK time, the BOA's Sarah Breeden will be speaking at City Week, speaking, of course, of the UK and the reaction from the BOE. So we'll be across those lines for you, of course. G7 finance ministers continue meeting in Paris, and Russian President Vladimir Putin travelling to Beijing for that visit. And aftermarket will get Euronext earnings results plus stateside Home Depot earnings out of the US, and of course the team there will be breaking those for you.
Looking forward to that a little bit later on. What else do you need to know this Tuesday morning with 50 minutes to go until the market open? Standard Chartered is planning to cut more than 15% of its back office jobs, joining other lenders in adopting AI to replace workers. The bank employed around 52,000 people in such roles at the end of last year, with a footprint spanning India, China, Poland, Singapore and Hong Kong. CEO Bill Winters has framed the move not as cost-cutting, but get this, rather replacing, quote, lower-value human capital in favour of machines. Talking of which, Meta is moving 7,000 employees to AI-related roles as part of a broad corporate restructuring that includes planned job cuts later this week. The company says the changes will create a flatter structure with smaller teams as it ramps up investment in AI products and infrastructure. And a jury has rejected Elon Musk's claims that OpenAI betrayed its mission to benefit the public by morphing into a for-profit business. Finding Musk waited too long to sue the company. The verdict follows a trial over the bitter feud between the entrepreneurs who worked together at the launch of the startup back in 2015. The outcome, of course, is a major relief for OpenAI, this as it weighs a potential IPO this year. Musk and his lawyers, they have vowed, of course, to appeal. This is one of the big IPOs that we are waiting for. So it looks like we could get one this week, but the kind of the OpenAI Anthropic story coming hot on the heels as well.
So that's the context, is that there is competition, obviously, between these two men around the race to AGI, but there's also the competition towards the race to the IPO. We have more details, of course, around the SpaceX IPO than we do around OpenAI's IPO at this point. But also, there's competition for liquidity. It doesn't seem like SpaceX is going to have much trouble in terms of attracting that ahead of its IPO, but that competition remains intense, and Musk says that he is going to potentially appeal this decision. But he's been relatively successful in court cases of recent times, but in this case, so far, a loss for Musk.
Yeah, I mean, Elon Musk saying he's going to appeal, as you said, because the substance of this was not tested, and he wants the substance to be tested. Interesting, though, tomorrow is a big day then in the SpaceX story, possibly, because we might get some further information about the timing, and some filings around that. But we heard from Elon Musk yesterday saying we've got to get the SpaceX IPO going here pretty soon, and that was enough to send space and space exploration and satellite stocks higher yesterday. We saw Firefly Aerospace, York Space Systems, Rocket Lab. These companies not seeing this as a competitive threat, it seems, or competition for liquidity in this space, but something that puts more focus on space more broadly. So tomorrow we watch. There's a launch as well, I think, from SpaceX.
Maybe this is the new high bandwidth memory trade, is just switch out of that and go to space.
Yeah, the two things in some ways are connected with the data centres in space.
There you go, back to data centres in space. Every story leads back to data centres in space. 12 minutes past 7 here in London this morning. Coming up, the EU races to finalise its trade deal with the US as the bloc seeks to avoid more Trump tariffs. We will have the details coming up shortly. Plus, Jensen Huang tells Bloomberg he believes the China market will eventually open up to Nvidia. We'll bring you some of that interview with the CEO later in the show. And up next, we'll be joined by Nicholas Bickel, who's the CIO at Edmund de Rothschild Private Bank. If you want to get involved in any of these conversations, IB plus BBTV Go. That's the function to use on the Bloomberg terminal. This is Bloomberg.
I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that, where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
President Trump speaking there at a White House event on Monday evening, with oil prices declining now on the back of those comments and other action taken by the Treasury in the US. President Trump says the US remains prepared to attack if an acceptable deal is not reached, but he did not give any specifics around any timeline. Let's bring in Jumana Basechi, who's Bloomberg's Horizons, Middle East and Africa anchor, of course, and with us in London this week. Jumana, good morning. So bring us up to date with the things that have stood out to you from what we've heard from President Trump and these latest threats around Iran.
Well, it was pretty revelatory what he was saying yesterday, both in the Truth Social post and in the little clip that you played, in that they appeared to be weighing up the possibility of military strikes, further military strikes on Iran. He says that they decided to hold off by a couple of days at the request of the Gulf allies. He specifically referenced Qatar, Saudi Arabia, and the UAE. And of course, we're taking this at face value. But yesterday, when we were sitting around here, we were talking about the fact that he once again threatened Iran. He said the clock is ticking. He's telling them to come back to the negotiating table and sign up to a peace deal. Now, what is going to happen in the next couple of days? We probably have a couple of days window to allow things to breathe. He does say that negotiations are going on in the background. And indeed, we know that these negotiations are happening. Iran once again submitted their refreshed, I would say, counterproposal via the Pakistani mediators to the U.S. yesterday. And we'll see where we go from here. But I think in terms of as it pertains to sort of markets and next steps, what is clear that's emerging from all of the reporting is that if we do get a breakthrough this week, it will likely be a framework around discussions as opposed to an active, fully comprehensive peace deal. You're going to get the sequencing, you're going to get an idea around how they're going to tackle the reopening of the straits, the issues around the sanctions, and of course the nuclear file. The US wants to lob everything together, the Iranians want to separate. So we'll see if that framework actually comes up this week.
And meanwhile, there's another benefit for the energy complex of Russia, it seems, because the US Treasury has extended this waiver, this sanctions waiver, for another 30 days, just as Vladimir Putin is about to set down in Beijing. That seems to be a win, at least on surface level, for Putin.
Well, absolutely. And it's funny because that announcement came after several hours of speculation, again, in Iranian state media, that the US were going to apply a waiver to Iranian oil sanctions, which clearly didn't manifest. But later on, Treasury Secretary put up a post, Scott Bessent, saying that they had once again extended the waiver on Russian oil. This is the second time they do so. It had expired a couple of days ago. So it's in place. But clearly it's just another measure that the U.S. government is taking to help put a lid on oil prices. Brent is sitting back at $110. We're still talking about the 2 blockades around the Strait of Hormuz. No end to that in sight. And more we hear of these energy experts and energy analysts saying that these stockpiles are being run down, and we are getting to a critical month in June where you could start to see an actual squeeze on physical supplies. The U.S. probably anticipating that, but giving this gift to President Putin.
Sure, we're still at 110 though.
We are still
and we
at
could squeeze from there, and that's the point.
And China have been buying less. They've been stockpiling less, which is the key factor here.
In terms of the demand side. Joanne, nice to see you. Thanks very much indeed for joining us once again. Joanne Absechi on what is happening with the Middle East story and how it relates to the oil story and how it relates to the inflation story and then how it relates to the bond market story, which we're all very much focused on. Nicholas Bickel, CIO at Edmund de Rothschild's Private Bank, joining us around the table to carry on the conversation. Good morning.
Good morning.
Selling bonds? Yeah,
I mean, we were selling sovereign bonds since many months, but I think we are at a pivotal level right now. Not surprisingly, it's focusing on a sovereign issue. I mean, it's not spreading to the corporate bond market as of today, but I mean, it's a signal that the market is sending to, government that probably surge in AI spending, high inflation, and the situation between Iran and the U.S., as well as this inflation around and rising deficits, surging deficits, is probably becoming an issue, at least for the sovereign rate.
You said at the moment it's not spreading into the corporate bond market, but does what happens in the sovereign government bond market stay in the sovereign government bond market? It has to impact other assets.
I mean, for the moment, it's focused on the sovereign bond market, and we do not see the spreads of the corporate raising much. I mean, the part of spread when you're buying a bond at 5% is really, really thin, and it's not spreading right now. But the reality is that if you have higher level of interest rates for a long time, you will have an effect also on equities. That's the reality, and especially the one which are highly indebted. I mean, even a hyperscaler, if you look at hyperscaler, they just announced more than 750 billion spending, which is quite equivalent to the cash flows they will generate this year. So they will have no liquidity room for buybacks. And I mean, they will need definitely to issue debt.
Okay, so it can weigh on those businesses, even though they're not maybe highly indebted, even if they're taking on debt, maybe not highly indebted, but it weighs on them because they don't do buybacks. Is that how these two stories come together?
Yeah, absolutely. And I think it's a question of time. Same as inflation. I mean, inflation is not an issue as soon, or raising oil price, as soon as it's only a question of time, and it's taking a few months to resolve, and I mean the Strait of Hormuz and so on. If we have a spike in sovereign rates for a couple of months, it won't be an issue because we're not in a deflationary situation, we're not in a recession. I mean, consumers are still consuming. So you have the other side, which can compensate for higher rates for a certain period of time. But definitely, if it's higher for longer, you will have an effect at the end of the day on equity market.
Okay, and how high should we expect Treasury yields to go in this context then, Nicholas? I mean, we're at 4.6% on the US 10-year. If we get to something like 5, well, is that likely? And what kind of impact does that, maybe just a psychological level, have on the markets?
Yeah, we won't be surprised to see the 10 years at 5%. That was our central scenario, I mean, back end of last year. We were I mean, betting on the steepening of the yield curve. Now we are seeing a more parallel shift around all the curve, and it's probably also putting pressure on Stephen Wire over the short term. But I mean, I won't be surprised to see 5%. And I mean, if we have a higher inflation and if the growth stays steady, it won't be an issue over the short term.
Would you buy at 5%?
No. Not yet. No,
so you see it going higher then?
Okay, yeah.
No, I mean, we may have short-term spikes. That's not unusual to see short-term spikes. And probably we'll start looking at 5%, but we probably won't buy it at 5% depending on all the other externalities. I mean, we have a lot of uncertainty around the market. And I mean, normally market hate uncertainty. They decided to skip it out and to focus on their certainties, which are earnings growth and capex from hyperscalers and to... But I mean, we are surrounded with uncertainty, so it's not the trigger of the 5% which will let us buy the treasuries at that stage.
What are you buying at this point? Are you looking at gold? Are you looking at tips? Are you looking at keeping cash on the sidelines? Where are you putting capital right now? I
mean, we are focusing on the reality, and the reality is that we had a tremendous earnings season. We had good guidance, and I mean, we haven't seen revised earnings due to higher inflation or higher energy price, even in Europe, not so much. So that's the reality of the market, which is having companies which are able to survive in this type of environment. And if you look at the past, having an inflation around 4%, if it's what we're looking at, is probably a good environment for equities. And it's probably the only assets which could, I mean, well perform in this steady 4% environment. So we're still overweighting equities, typically in the US and around all these capex, rather than focusing on the consumption and staple and so on. But I mean, we're still overweighting equities, but we're reasonably confident that we'll have a normalization of the performance after, what, seven weeks of growth, 7 weeks of bounce back in the market. That's not unusual that we'll see a kind of re-rating, I will say.
So you're buying equities for the nominal growth hedge. You said you wouldn't buy at 5%. I just want to follow up on this point. And you said it could spike through that.
Yeah.
To where?
I mean, that won't be the only trigger.
Sure,
I mean,
but how high could a US 10-year go?
We'll start looking at it. Definitely endowment fund or life insurance, which have very long time horizon, that will start to buy at 5%, 5.5%.
Where would you start to buy?
What we'll start to buy when we will see the end of a steepening of the yield curve. I mean, I won't buy duration if I believe that the steepening of the yield curve will continue.
So, so you think,
you
think it will?
Yeah,
by the sounds of things. 550, 6%?
Well, I mean, who knows? The sky is the limit, I would say. But I think 5% will be probably the starting point to look at the bond, but won't be a trigger to start buying massively treasuries, I think.
Unless we get the reopening of the Strait.
But if we get the reopening of the Straits, probably we'll have decelerating inflation and we'll have also decelerating rates. I mean, it's also a combination of all that factors. And I mean, higher interest rates, long-term interest rate, is also a reflection of higher growth. I mean, we are facing companies' growth and companies' earning growth, and which also pledge for higher yield, I mean, at the end of the day.
Okay, Nicolas, thank you very much indeed. Thanks for joining us.
My pleasure.
This Tuesday morning, Nicolas Bichel, CIO at Edmond de Rothschild's Private Bank. Coming up, we're going to go to the G7 finance ministers meeting in Paris and speak exclusively to Mathias Cormann, Secretary General of the OECD. That's coming up next. This is Bloomberg.
Minutes to go until the start of trading here in Europe. Let's talk about where we are right now. At the moment, Europe actually looks fairly good in terms of the futures picture. We are looking at a positive story, as you can see. If the Cosby goes down, does Europe go up? Is that the trade that we're watching here at the moment? There's a little bit of that maybe in the market this morning, but we'll dig into the details as we work our way towards that opening trade, Anna.
Yeah, European stocks then disconnected perhaps from some of the tech themes in the Kospi, also maybe disconnected from the Japanese dynamics in bond markets right now. The Japanese story was higher yields, up 6 basis points this at the 10-year. We're pretty flat across the European space today in terms of the 10-year horizon at least. I can see very small movement either side of the flat line on these bond markets. Yesterday, the direction of travel was lower yields, even more so in the UK. So we'll watch the gilt open, of course, at the start of the 8 o'clock hour.
Well, that global bond market sell-off has taken centre stage as a group of 7 G7 finance chiefs discuss how oil-fuelled inflation risks overshadowing the world's economic prospects. Bloomberg's chief Europe correspondent, Oliver Crook, is in Paris for the meeting. Ollie.
Yeah, that's right. There's a lot of conversations here about the impact, of course, of the Iran war, what is the effect it's having on growth and, of course, on inflation. And that is going to be one of these sort of areas of expertise for our next guest here, who is Mathias Cormann, the Secretary General of the OECD, who has one of the broadest views, I think, on the global economy. And we'll have a sort of interesting analysis of the effects so far of this war in Iran. So I'd like to just begin there with your perspective on kind of what we've seen. It's changing day to day, but your assessment of the impact on growth and inflation across the world.
Well, I mean, the overall assessment is that it's putting downward pressure on growth and it's putting upward pressure on inflation. I mean, we provided an initial assessment in our interim economic outlook in March, but we will be revising that assessment in the next few weeks in a formal sense. But clearly, downward pressure on growth and upward pressure on inflation.
Yeah, and you were one of the first to revise your economic forecast after the war, and of course everybody has sort of followed suit for that. For the new forecasts that are come out, is there going to be upside or downside risk, or you expect that inflation expectations are higher and growth lower? Is that
well, look, I mean, at the moment there's clearly a lot of downside risk, and in as much as the conflict in the Middle East is concerned, I mean, nobody really knows how much longer it will go for and how much worse it might get. But in the meantime, and of course, the longer it goes, the higher the risk of secondary effects. I mean, we've had a very significant energy supply shock, a very significant energy price shock. But of course, what we are interested in, what we're watching, is to what extent there is now a flow-through effect on prices more broadly, on wages, and I mean that is of course also what central banks would be looking at in setting their monetary policy. And
as you have the conversations in this room with these central bankers and these finance ministers, do you feel that the sort of greater risk is to growth or to inflation? Is it right to sort of categorize this? Because there's a big debate about acting too soon, acting too late.
Well, I mean, the challenge for policymakers in terms of monetary policy now is that we have both an elevated risk of higher inflation at the same time as their downside risks in terms of the growth outlook. So, clearly, central bankers will look very carefully at the data. They will focus on making sure that inflation expectations remain anchored, and it's going to be important to communicate very clearly the balance of decisions. I mean, normally you would be able to see through an energy price shock, but of course, if it starts contaminating prices more broadly, if you see increases in wages as secondary effects, then central banks will need to take action, even if the economic growth outlook is somewhat weaker.
And we've seen, we heard from Christine Lagarde from the rate decision last time around, saying that the secondary effects weren't really materializing yet, but that was a couple of weeks ago. Are you starting to see the secondary effects materialize?
Well, I mean, that is what we're keeping an eye on. I mean, across advanced economies, what we see is that core inflation remains, relatively okay. Yeah. But of course, I mean, that's precisely what we will be looking at.
And thinking about the G7 sort of format, this is obviously a format that was originally sort of designed to deal with exactly these kinds of global shocks. We now have an administration in the United States that takes a more skeptical approach, to say the least, to sort of multilateral organizations. What do you think is capable, what is able to be achieved and sort of deployed at the G7 level to sort of dampen some of these effects?
Well, I mean, I think the G7 is an incredibly important format. I mean, having the United States as the biggest economy in the world, working together with, all of the other major economies, advanced economies, market-based democracies around the world. I mean, I think it's a very important platform for dialogue, for cooperation. In the end, working together on shared approaches, on common approaches, helps to lower costs, helps to boost certainty for business, and I mean that's good for the economy everywhere, and it's good for the economy in the United States.
And is there a sense that, because obviously the war in Iran is a very large undertaking by the United States, I think one that the United States is starting to realize they may may need some more support from some of the peers in the G7. Are you getting a more conciliatory tone from the United States?
I think the tone across the G7 is always constructive. I mean, of course, at different times there are different challenges that need to be worked through, but it's always with a view of finding the best possible solutions, of course.
Well, the French finance minister yesterday accused me of depressing him, but I'm going to put a similar question to you about the sort of larger picture where we see, obviously, growth being choked out, inflation rising. We're seeing rates going to be rising across the globe, very, very likely, at a time when fiscal space is very, very stretched. And in the United States, you have a parabolic equity market, equity markets in Europe, still relatively close to all-time highs. Do you not see the potential here for a sort of disorderly shift, particularly now that it seems like the bond market is waking up to this and rates are going higher, higher, higher?
Well, we've got to remember over the last 6 years or so, there have been a succession of very significant shocks to the global economy. And the global economy has been remarkably resilient. It is true that we are now testing that resilience. But when I look at where we were at the end of 2025, coming into 2026, we were about to upgrade the growth outlook. I mean, there are different things that are happening in the economy at any one point in time. And then there are also some positive developments in the economy. And all of the investment associated with the AI transformation are very, very significant and are drivers of growth. So, I mean, of course, it would be better if there was a resolution to the Middle East conflict sooner rather than later in terms of the global economic growth outlook. Of course, that would be better. But when we look at the way the global economy has performed, it's been remarkable, the resilience that's been demonstrated.
And you mentioned AI, and that's something that obviously I think economists are taking a very close look at. Obviously productivity gains, but also the impact on the labor market. We just had a story out today about StanChart saying that they're going to cut some of their corporate functions by 15% by 2030. What is the balance of sort of risk from AI in terms of the research that you've done so far?
Well, I mean, clearly the benefit, there's going to be incredible benefits for humanity. I mean, there will be a big transformation in the labor market. I mean, labor market requirements will change, as they always do when you have significant structural transformations in the economy. But, on balance, we see it as a positive, including for the labor market.
And something that you're obviously in charge of and spent a lot of time on is digital taxes and the taxation agenda across the world. Pillar 1, we understand the United States wants that to be delayed. Is there a risk that there's going to be now fragmentation, everybody kind of going their own way on digital taxes? What update can you give us?
Well, the first point is that, global minimum tax has been an unmitigated success in terms of multilateralism. When we have an agreement, including with the United States, on the operation of global minimum taxes moving forward, which was supported by 147 countries and jurisdictions around the world. In relation to Pillar 1, the reallocation of taxing rights, it's true that is the more challenging part of the conversation as we seek to make international tax arrangements fairer and function better in a globalized, digitalized world. But the conversation is continuing. I mean, the United States and others remain at the table. What we don't want is a return to unilateral digital services taxes. I mean, it is much better to have an agreed multilateral solution that provides fairness and that is effective for everyone.
Well, Mathias, Cormann, thank you very much. That's the Secretary General of the OECD here, assessing the situation, obviously, for inflation, for growth, but of course multilateralism and that all-important sort of digital and global tax system.
Ollie, great interview. Thank you very much indeed for bringing it to us. Oliver Crook, our Europe correspondent. Let's turn our attention to what is happening in the bond market. Investors very much weighing in on the recent bond market sell-off and the challenges that it poses to central banks.
There is a risk premium being priced. If the Fed's going to restart a hiking cycle, they're not just going to hike once or twice. They're going to hike multiple times. And it's going to be on the backdrop of a stronger economy. At this point, there really isn't enough in the data to make that conclusion.
We're not there yet, but we're getting there. Kelsey Barrett, fixed income portfolio manager at JP Morgan Asset Management, talking to the team stateside. We're going to discuss more on that risk story for global central banks next. This is Bloomberg. 42 minutes past the hour, 43 minutes past the hour. Welcome back. You are watching the opening trade. European futures are positive. US futures are negative. The Nasdaq is down by around 0.3%. But let's turn our attention to what is happening on the other side of the world. Japan's economy growing much faster than expected at the start of this year. This solid expansion, one could argue, gives the BOJ maybe scope to argue that the economy is resilient enough to withstand maybe higher borrowing costs. The central bank may be looking to continue its normalisation policy, maybe to accelerate that normalisation policy. Bloomberg's Japan economy and government reporter Paul Jackson joining us from Tokyo. Did this data give the green light to the BOJ? Is it June or is it July?
I think that's pretty close to the mark. It creates a window of opportunity that the Bank of Japan really should grasp, I think. If it doesn't act quickly on inflation, that could start to get a bit hairy down the line. And also, we've got the yen in a very vulnerable spot, not to mention, the impact on potentially on yields. I think if they do raise in June, that will perhaps help to take a bit of the edge off the super long range, which has set new record highs just today, the 30 and 40 year tenors. So I think an early move before signs of the war, like weakening the economy going ahead, which could become more apparent in the current quarter. I think you've got everything aligned optics-wise to move, as you say, in June or July. Now, I think the market has got 70% on overnight swaps, expecting a move in June. I think that's the time when they should go. Could be some upset if they don't go then. And that's really the kind of environment we're heading into, is if they don't move, it's going to really get messy and cause ructions in markets.
Paul, would that move higher then in June, as the markets are starting to price, be accompanied by a stronger fiscal impulse from the government? The Prime Minister is discussing and working through a potential additional budget. What are the details of that, and how could that impact the BOJ's decision?
Well, I mean, I think the launching of an extra budget at this point may make investors think, whoa, what's going on? This is Prime Minister Takaichi on her expansionary fiscal policy. She's out of control with the spending, getting into that kind of narrative again. But the reality is these emergency measures are taking on energy to try and limit the impact of the Middle East war and the energy prices. The figures are adding up on the subsidy prices. So these measures that they're taking are chewing up a lot of money, and they essentially have to have an extra budget to pay for it. But the way investors view the extra budget, and we still don't know the size of it, could start to play out again in the bond yields and put quite a lot of pressure on the government again. So I think really a rate hike in June is probably your best option to just try and calm markets down and show that authorities in Japan are taking the inflation situation seriously, and that they will keep on top of it going forward.
Paul, thanks very much. Bloomberg's Paul Jackson live in Tokyo for us with the Japanese story. Let's turn our attention to global markets then, with the markets in 3 minutes on the opening trade, with Markets Live Executive Editor Mark Cudmore. Mark, good morning. So we're just hearing there about the Japanese story. The role that Japanese bond markets are playing is a really interesting one right now. Looking at the US Treasury market, though, 4.6% on the 10-year. We spoke to a guest earlier on who was talking about, this likely to go to 5% in his view, and even that might not encourage him into the market. How are you thinking about the global bond conversation at this stage?
First of all, in a longer-term view, I completely agree with that guest. I think ultimately yields are going a lot higher. I just think this does not happen rapidly or in a straight line. I've had that view for the last, number of years, and I think we're going into a much higher range, and that plays out over years. And the reason that is that ultimately there are a lot of people who are income collectors who will basically seize jumps in yields as a chance to just buy into long-term bonds. So the kind of transition to a higher yield environment takes place over months and if not years. But I think we do need to move into that world. In the short term, I don't think bonds are quite out of the current sell-off just yet. we've paused in the short term. I think some of the political concerns in the UK have damped down a little bit with, the comments from Andy Burnham last night about being a little bit more fiscally restrained or expressing sentiment in that regard. And also Trump, again, providing some people who I think real optimists out there that there might be a diplomatic solution to the Strait of Hormuz. So it's temporarily paused, but I think this sell-off has more to go in the short term. Then we'll get those dip buyers in bonds. But later on this year, we'll see much higher yields again.
How do stocks do if yields are going higher over the long term?
So I actually think that stocks can cope okay with higher yields if it's for the right reason. If that's because the economy is doing really well, then that's actually okay. Now, the problem is we have higher yields for some good reasons. There is a relatively resilient and strong economy, and we've got a lot of spending in the AI space, which is driving the K-shaped economy or supporting the K-shaped economy. But we also have higher yields for a lot of bad reasons. We have the supply side inflation shock, which isn't being resolved, and we have fiscal concerns. So that's an image to say that I think it's going to ebb and flow. Ultimately, higher yields are bad for stocks, but it's maybe less dramatic kind of at some binary level. I will say, though, given the move higher in yields the last couple of weeks, I actually think right now bonds are closer to the dip buying moment than stocks. We talked about this yesterday. I think we're now in a couple of weeks where stocks can retrench a bit, only in context of the extraordinary gains. This is not the end of the bubble. The dip will be bought again, but the dip won't be bought that quickly.
Mark, I was going to follow with that, with what the dip buying impulse will be, particularly when it comes to the semis and the sell-off that we've seen in the US and Asia today as well. You think that could happen, but maybe at a more moderated pace?
Yeah, I just think you've got to put it in context of two things. One is we've just seen extraordinary gains. So quite sizable headline pullbacks will still leave us like massively up on any reasonable look back window. So it's not kind of blowing up this kind of this bubblicious bull market we're seeing in this sector. We've also got just massive herding because everyone's using the same AI advice for these trades. So that's why I think it can be quite painful. It'll clean out the first initial dip buyers who then get cleaned out. So maybe this lasts a few weeks this time.
Bloomberg Markets Live Executive Editor, Mark Cudmore. Mark, thank you. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on the terminal. Let's bring in Charlie Wells right now, standing by for your stocks to watch this Tuesday. Charlie.
Good morning, Tom. So look, let's start with chips because we're getting some conflicting signals here. I want to bring up yesterday's trade because this is really interesting, right? And we're getting some conflicting signals as well, right? Jitters over in Asia on tech. Let's look at yesterday's trade. We see red here, but you also see some green on that screen with Infineon. They got a price target upgrade from Morgan Stanley, so that seemed to give them a boost yesterday. Interesting, and you're going to want to pay attention to BE Semi because they also today got that price target increase. Does that give them a lift in a sort of jittery space? That is definitely one to watch. Let's take a look at an individual company, Delivery Hero. I want to bring them up because late in the day yesterday, we got news that Uber had increased its stake in the company to 25% if you include options there. So interesting because Delivery Hero this month has been on an upward journey. You see that kind of positivity coming early in the month when we got news of one of their largest shareholders selling some stakes. You also saw another bump when you got to some management changes. So does this continue? There's also this narrative coming out. Bloomberg Intelligence talking about it, about how Uber increasing its stake to 25%. That leaves optionality for a takeover. So again, do we see this positive momentum when the market starts to open with Delivery Hero? That is one to watch as well. Let's end with Standard Chartered because we have that headline out this morning. Bill Winters, the CEO, talking about how the company by 2030 could replace some 15% of support staff with AI. Now, what we know is when we hear these sorts of headlines coming from firms, the market tends to reward them. They like that efficiency story, but we're also starting to get pushback on that narrative of this claim of potential AI washing. Are these really kind of efficiencies, or is this just job cuts colored by AI? So that's the question we're going to want to have as we go into trading with Standard Chartered this morning.
Charlie, thanks very much. Charlie, with some of the stocks in focus, I'll add a couple of UK names that have caught my attention this morning. Currys, if we're keeping track of the consumer, especially with the labour market data out this morning and showing signs of a little bit of softening, but they see their full-year adjusted pre-tax profit coming in higher than had previously been expected, at least at the top end of the range. So maybe that's a positive on the UK consumer, and a little broader across Europe. And Crest Nicholson, also in the UK, this a real estate business. They're delaying the publication of their half-year results because they are still trying to conclude talks with their lenders. This is a story that we know a little bit about already. So I wonder what's in the price and whether there's any further movement on this one.
The UK housing market is struggling. Yields are high. How do you get a mortgage? Can you get a mortgage with any degree of certainty? What is happening in terms of input prices into that sector, labour as well? There's so much going on. It's a really tough place to be. This is at a time when we thought we were going to get a housing boom. So investors had positioned that, and it didn't materialise.
Yeah.
Because at the end of last year, the expectation was that the Bank of England would be cutting 2 to 3 times, so that the economy would be ticking over with some level of growth, that inflation would be coming down. All those things have changed, putting that additional pressure on the housing market of the UK.
And we had that labour market data out this morning, and it was the payrolled employees number that looks weak. And that's put a bit of downward pressure on the pound, actually, going into today's session. So the payrolled employees number dropping 100,000. It was supposed to be down by about 10,000. Yeah. So we'll get a chart in the next part of the programme, but it does show a bit of a drop downwards. And is that going to be something that limits the number of hikes we can get from the BOE?
If the US 10-year goes to 5%, where will that put gilts? We're at 4 points. Where are we now? 5%. Do we get to 5.5? Do we get to 6%? What would a 6%? I appreciate we're dealing with probably more 2-year swaps and the kind of that. But what would those kinds of levels do to the UK housing market in terms of just affordability?
Yeah, and people asking questions about the US housing market with the 30 yield doing what it's doing at the moment, because that's the part of the curve that's crucial in that geography.
Yeah, how much is priced into the 10-year right now? Are we pricing in 2-3 hikes from the BOE? Does it push it higher on that? The 30-year is close to 6% anyway. It's a step away from that right now, 5.75. But of course, the focus remains on the 10-year.
With all that said, futures are pointing higher, partly because we don't have quite so much tech, perhaps, here. Certainly not as much as the Kospi. The Kospi is on the back foot over in Asia, but Europe is looking a little brighter. So with one guest accusing Oliver Crook of depressing him, we certainly won't be accused of that this morning. European futures pointing a little higher this morning. We'll be back with the market open. This is Bloomberg.
Tuesday morning, good morning. Couple of minutes to go until the equity trade kicks into gear here in Europe. We are looking at actually fairly positive futures here in Europe, which is interesting in light of what happened overnight out of Asia and in the United States. This was the session for the S&P yesterday. What you saw was energy doing quite well, but what you saw is information tech doing less well. And that continued into the Asian trade. Stocks like the Kospi, markets like the Kospi coming down pretty sharply. And in some ways, this favours Europe. We are the anti-Kospi trade. We don't have much tech here, so actually maybe on days like today, Tom, we benefit.
At least for today, that is the dynamic that you could point to with gains in the futures. European futures looking to build on the upside of yesterday, pointing up by 0.3%. Yesterday, it was media at the top of the list in terms of your sectors, was autos under pressure. Today, look at the basic resources, look at energy, of course, Brent a little softer in the session. WTI, though, in positive territory the last time I checked. FTSE 100 futures pointed to gains of 47 points, up 0.5%. DAX futures looking to add around 74 points, up 0.3%, Anna.
Let's talk about some of the individual stocks in focus then, Tom, as we head towards the market open for this Tuesday morning. And we'll start with the banking sector. Standard Chartered is in focus. The CEO saying AI will replace, quote, lower value human capital, which sounds a bit ominous. But we'll watch that one at the start of trade to see where that takes us. There's been a briefing with media, it seems, over in Hong Kong, I think, certainly in Asia. Delivery Hero in focus as well. Uber Technologies has increased its stake in the German food delivery company Delivery Hero. They're trying to counter competition from DoorDash outside the United States. They don't want to buy as much as 30% of Delivery Hero, which would trigger a bid, of course. And Currys, we'll watch that one with the consumer in mind as they edge up their guidance for the full year. Guy.
OK, which is good. Positive news out of the UK. We're in need of that. Let's talk about what these markets are delivering this morning. Let's start the Tuesday session, get it underway. We are expecting a positive picture to emerge out of Europe this morning. Less tech maybe helps. Yesterday, energy did well in the United States. Does that feed through to what we're seeing here in Europe? The FTSE 100 can't make up its mind yet. Which direction is it going to go in? Looks like it's going to be positive. The Stoxx 600 is up 0.1%. These aren't big gains, but considering the losses that we've seen overnight out of Asia, then actually holding the ground may be a good thing. So we're expecting that to maybe persist across most of the rest of Europe. We are expecting most markets to be in just positive territory, and that's what we're seeing. Clearly nothing happening in Germany this morning. We are open. We're up by 0.3%. Most markets up 0.1%. Doesn't look exciting, but in the context of what we're seeing elsewhere, it doesn't look bad, Tom.
On the sector-by-sector basis, top of the list right now is personal care. That sector up close to 1%, followed by media. Another decent day for that sector, which was the best performing sector yesterday, up 0.9%. On the downside, given the softness that we're seeing, particularly in silver prices today, but also gold a little weaker. Basic resources, the biggest losses coming through there on that sector, down 1.3%. Construction and materials also weaker by 0.4%. Just four sectors in negative territory so far, with the top gains coming through for media, at least for now. Gains of more than 1%, Anna.
Yeah, it's a day where basic resources perhaps should have had a bit of a bigger mention, because that is by far and away the worst performing sector. There aren't many negative sectors, as you point out, Tom, but we're down 2% on Anglo-American, on Glencore and Antofagasta. So that's taking the edge off London, perhaps, which is kind of in the mix, isn't it? It's not really standing out today as looking very different. The CAC is up 0.1% or 2%, so is the Xetra DAX, so is the FTSE 100. So modest gains then, Guy, across these European equity markets.
Looks like, yeah, steel is an interesting area to maybe watch out for this morning. In terms of what we are watching, is it a feed across? Is today the day when actually Europe's, can I say boringness? No tech? Actually shines a little bit. And maybe this is going to be the future, because potentially there is significant volatility. We're going to see maybe some of these trades rolling off. Are we going to see people looking for that diversification trade to deliver? I don't know. Let's try and find out.
OK, let's get another perspective, certainly on what's happening in the UK stock story right now. We'll get some analysis from Alexandra Jackson, Director of Equities at Rathbones Asset Management, with us on set this morning. Hi, Alexandra. Nice to see you. So I know that you have quite a lot of conviction around UK mid-caps, and it's the mid-caps area I think you focus on, and there were a number of underpinnings for that. So today looks fairly quiet, so a good day to take a step back and talk about maybe some of the reasons that you have conviction around that UK narrative.
Yeah, absolutely. I mean, the UK does look kind of messy at a headline level, at a macro level. We've got the domestic politics, we've got rates, we've got the geopolitics. But actually, when you look underneath a little bit, you can see this divergence appearing. Valuations are low. You don't need me to tell you that. Balance sheets are very strong. And actually, M&A has really picked up. We're running at double the usual level in the UK. Premiums are actually higher, and average deal size is higher. So that's interesting. Someone is buying these companies.
Somebody is buying these companies. How much do you worry about the macro effect then, certainly at that mid-cap level? Because if you look at the 250, it's underperformed. The FTSE 100 hasn't it of late, and part of that is, I guess, to do with concerns around the macro story. This morning we had numbers out from the UK, and the labour market story there. The number of payrolled employees dropping by 100,000, which was a lot more than expected. We're edging higher on unemployment. Is this something that threatens to take the edge off your investment thesis?
Well, I think it's kind of double-edged. It's both the gating and the unlock for me. So rates are really important to the mid-cap trade. The FTSE 250 is very correlated to yields. And actually that unemployment data this morning, it looks a bit softer, but it suggests maybe that companies, and the companies that we talk to, will get more of a steer on that later this week. But the companies maybe are choosing to lose workers rather than raise prices. So maybe that keeps a lid on inflation throughout the rest of the year. Keeps a lid on yields as well. And again, that's the unlock for this 250 trade.
And you talked about 250 being sensitive, or those mid-caps being sensitive to high yields. Yeah. What assumptions then are you making about rates going forward from the BOE?
The market is forecasting a kind of 80% chance of a hike before the end of the next two meetings. So that looks pretty aggressive to us. Sarah Breeden over the weekend was saying she didn't see a need to raise rates from here. I think she was indicating they're in a wait and see.
Do you need rates to be on hold for that, to continue to have that conviction in UK 250?
Yeah, I think the ideal scenario is for rates to be on hold and then to start to come down, and that's where you see the mid 250 really start to move.
At the moment, you've got a gilt yield 10-year, north of 5%. You've got a yield on the 250 of 3.5%. Why am I buying the 250?
I think you've got some really interesting companies there. So we are looking at ways to play the AI trade in the UK, for example. As you said this morning, not a lot of tech in the UK. It's one of the reasons the UK is probably underperformed, but might give some protection now. For us, industrials are where the AI names are hiding. So even just this morning, we had Diploma out with numbers today, a nice beat, talking about high teens organic growth. And they are a play on the kind of build out of physical infrastructure, physical data centers. So they provide cabling and wiring and connectors into data centers. So that's one of those examples where you can access interesting structural growth. In the mid 250, they trade on a cheaper valuation than their sort of US listed peers.
Why do you think people are missing them?
I think they probably have been overlooked because a lot of the macro keeps people out of this market. Probably they're not. They're not single plays. You know, they might do a couple of different things.
Do you need? Okay, so they're not pure play.
They're not pure play.
Okay, so that dilutes maybe the argument a little bit, but I'm wondering what will it take for people to notice them? And is it important? Does the investment case need people to notice them? Because if they don't notice them, then it's great. We're going to do really well. We're going to kick out a decent return, but we're not going to get that kind of stratospheric performance that the rest of the AI trade is delivering. How do we get people to notice these stocks, other than you coming here and telling us about them?
We've got a graphic to put up next as you answer. There you go. Then people will notice.
A graphic sounds great. I think part of that will be other companies coming in and buying these names. We see strategic, we see trade buyers, we see PE all over these.
So this is just a takeout trade. It's not an organic. It's a people are going to buy these companies for better multiples than they're trading on at the moment.
I would say the takeout trade is is there to prove out the valuation, and then we can move forward because these businesses are generating incredible levels of organic growth. A lot of them will grow their margins. They're returning lots of cash to shareholders. You know, they're becoming very shareholder friendly.
So we just put up a graphic. It had Renishaw and Halma, which I know are two companies that I think that you own, Alexandra. So industrial tech, is that the way that you play it in the UK, to Guy's point? And what does that mean? What is it that these guys are doing? How does it feed into the data centre story?
Yeah, so you could either play the kind of physical build-out like a Diploma or something like that, a Hill & Smith, or you could play those names that provide kind of components into the semiconductor equipment manufacturing piece. So that's what Oxford Instruments and Renishaw both do broadly. You need to be able to measure the position when you're making semiconductor chips very, very carefully at the kind of nanometer level, and Renishaw provides some technology to do that.
Are these businesses seeing sort of step changes in their profits or their sales, or big pivots in their business lines to focus on this stuff, or are these sort of at the margin interesting dynamics?
A little bit of both, depending on the company that you're looking at. But certainly, when you look at the divisions of these businesses that are focused on the semi customers, you can see a step change, certainly in levels of organic growth, in the investment that companies will put behind that, because they can see the duration of this demand really proving out that revenue visibility. But they're not 100% AI trades.
As we talk about the takeout trade and maybe the role of private equity and others in terms of looking at acquisitions in the UK, on the other side of the dynamic, in terms of the IPO pipeline, how closely do you monitor that? Is that pipeline, how healthy is that looking? Are we going to get more tech names from that currently in the private sector? We have some strong tech, but in the public world, less so.
Yeah, we do have some strong tech in the private world. We have recently had meetings with, I would say, 7 or 8 UK private companies, most of them tech or tech adjacent, that are thinking about listing. They won't give me a timeline, but
in the UK.
In the UK, yeah, mainly in the kind of mid-cap space, not huge companies for sure. But that gives me a huge amount of confidence that we can, at some point, when that IPO market does sort of unlock, and we need a bit more confidence, we need that market to unlock for these companies to really want to come to market and get the right valuation. But they're very keen.
That's interesting, because in the States, well, in lots of parts of the world, they tend to skip the mid-cap phase, just list as giants. It seems that's the more recent trend.
Yeah, well, that will be a good differentiator, I think, for the UK.
Right, yeah, so some mid-cap tech names to play for.
Does that, if we get a change in government, how do the macro story is ever present in the UK? How does that put investors off? when you talk to international investors, how do they feel about the UK right now? Do they look at the politics and go, do you know what, I'll put that one to one side for now? How does what is happening domestically here change the international investors' perception? How is it changing the international perception?
Yeah, I think it's fair that global investors have been able to ignore the UK in recent years. What we see now is actually a bit more interest coming from my clients, coming from other global investors. Yeah. And when I go to conferences and things, I can see that there are more global investors there who are looking at interesting UK businesses, particularly those kind of global growth stories. You know, we see the UK as kind of a hunting ground for global growth names that are mispriced just because of where they list.
But this is individual names. This isn't a wholesale, we're interested in the UK. It is, there's some underpriced assets here that we think we can take advantage of.
I think that's probably mainly right. This isn't a market that you want necessarily passive level exposure
to. You don't know an index. This isn't an index market.
For me, I would prefer to be much more selective.
Okay, really nice to see you. Thank you very much indeed for stopping by. Alexandra Jackson, Director of Equities at Rathbones Asset Management. Core 6 looks a little bit like this right now. Let me just give you an idea of what is going on in terms of the main names that we watch. Tech is under a little bit of pressure. You can see that in ASML and Schneider. You are also looking at a fairly decent bid actually coming back into Nestle. That was a story yesterday, maybe we saw coming out of the States as well. Some of the more consumer-facing stocks doing a little bit better. But let's get more detail on what is happening here. Charlie Wells is starting with Anna's stock of the morning. Currys.
Yes, I am, Guy. It's an interesting start, an optimistic start, I would say, for Currys. They raised their forward guidance, and basically the market is liking what it's seeing here. This really seems to speak to the consumer, right, of strength. Of Currys basically saying they're really not impacted, at least so far, by some of the uncertainty that we've been seeing across the globe. You know, consumers continuing to buy these electronic devices, so the market liking that, giving an optimistic tone that we haven't seen across the board, really. Let's flip and stay on a similar story with Doc Martens, right? That shoe company, they're up over 7% this morning. And again, they met expectations. And this really kind of brings to bear that tone on the consumer, given a lot of the uncertainty, given a lot of the negativity that we've seen, still holding up. So the market liking what it's seeing there. Different story with Vallourec. Let's bring this up. This is that French tube making company. They are down almost 8% this morning. ArcelorMittal sold about 10% of outstanding share capital. The market really not liking that, despite the fact that ArcelorMittal said that really they continue to believe in, you know, the strategy of this company, but a lot of negativity around there. Let's end this morning with Aixtron. That is one of the main European semiconductor companies. They're up just over 1.5% this morning. They reported some strong orders. So this is really going to be in focus, these semiconductor companies, because we're seeing jitters in Asia. This is some green on the screen here. We'd seen earlier, you know, some red for a number of these other semiconductor companies across Asia. So how does it kind of spill out here in Europe? We're seeing positivity from these orders in Aixtron, and of course, a lot of focus on semis given those NVIDIA earnings tomorrow.
Charlie Wells, thank you very much indeed on some of the stocks on the move this Tuesday. Coming up, global memory stocks, as we've been talking about, taking a hit after comments from the Seagate CEO, sparks fears about the industry keeping up with demand. That is next. This is Bloomberg.
The Chinese government has to decide how much of their local market do they want to protect, and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
That, of course, was NVIDIA CEO Jensen Huang speaking exclusively to Bloomberg's Ed Ludlow. Asian memory stocks, meanwhile, lower in today's trade, tracking losses from US peers after Seagate, the CEO, said building new factories would, quote, take too long, sparking fears it won't be able to keep up with soaring chip demand. Neil Campling, our senior market strategist, joins us now. So the blistering rally then in semiconductor stocks. It was interesting to see that software stocks actually performed quite well in the US session yesterday. Semis under pressure. Is this a blip? Does buy the dip come back in to rescue the chip makers? Or does it point to over-exuberance in terms of the capital that's been piled in to the chip stocks, both in Asia and the US?
A great question. I think as far as whether it's a buy the dip or not, perhaps we'll rely on what Jensen says tomorrow night when NVIDIA report numbers.
Yeah.
In terms of exuberance, you could just look at some of the products that are created in the markets around some of these semiconductors. For example, there is a XXX levered semiconductor ETF. It went from the end of March until the end of last week up 350%. And it's down.
So Guy Johnson put his entire pension into.
Guy put his entire net wealth into this product, and he obviously got out at the end of last week before it fell 25%.
It's amazing, isn't it?
So, well done, Guy. I mean, I'm not sure why you're still sitting here. You should be a trader, clearly working at one of the big investment banks.
Yeah, it's my moonlighting job.
Well, I mean, I'm a man of many talents, but we've discussed before that some of the money that's flowing into this. We've got fund manager surveys, which we'll be bringing out some detailed analysis on in the next couple of hours. But again, it shows there's a massive drive in terms of asset allocation into semis, into AI, into the chip sector.
Yeah.
So on an institutional basis, it's very difficult to see where incremental money comes into. In the meantime, retail investors have been borrowing money to buy into a leveraged product. So momentum works both ways.
Double leverage. That would be
triple.
Yeah, no, but that's 3 times plus a bit of leverage on top. Yeah.
Plus the original investment vehicle it's invested into. Yeah. So it's momentum works both ways. It's great on the way up, and it can also hurt. You
can see it in factors. If you go to FTW on the Bloomberg, you can see factors to watch. And you look at kind of momentum has been at the top of that board for a long time. Last few days, not so much.
Absolutely. Last 2 days, last 2 sessions, and where are in the US? What sectors are performing well? Energy for obvious reasons, but also catch up from things like utilities, which is and some very defensive areas of pockets of the market. So it's going to be interesting to see how things play out in the next couple of sessions, whether it's buy the dip, as Tom mentioned, or whether it's more of the same in terms of a further sell-off.
Neil, I wonder what you thought of the comments by the Seagate CEO. We were discussing at the top of the programme. Should this have been positive or negative for those in that memory sector, the memory chip makers? Because the CEO says new factories would take too long. Does that give you comfort? He's not going to spend too much money and the bottom line is going to be damaged by that. Or does it make you think he's going to miss out? But that doesn't make sense because the whole sector sold off. So who's he missing out to? What explained the negativity around those comments, do you think?
The negativity, I think, is perhaps because of this momentum factor. As far as profitability is concerned, what he's doing is maximising profits for his company because he knows that this is a highly cyclical industry. It has been always. And even when you have the AI impetus, it's likely to remain a cyclical industry. So you maximise the profitability because, as he was saying, regarding building out new capacity, it takes between 3 and 5 years to build a new plant.
Is he saying that the time? Basically, you're saying in 3 to 5 years' time, I think this is going to be. Maybe this will be.
You could read into that. You could read into the return on an 8-figure investment into a new facility. You won't get those returns in 5 years because the chips won't be commanding. We've seen some chip prices go up by 600% in 6 months. You can't sustain that for the next 5 years. So why would he look to be building out now in that increasing capacity? Because we've seen before the margins in these parts of the market, when they are supernormally high, can also go to depressed levels. There are some memory companies, don't forget, that in previous cycle downturns get to negative margins. So we are at extremes on the other sense at the moment.
Yes, they may have some memory of that. Terrible joke. Meanwhile, Blackstone. It's awful, isn't it?
I'll be the trader, he'll be the comedian.
That even made Neil cringe. Meanwhile, Google and Blackstone, though, if they have that 3 to 4 year horizon, I mean, they're looking to spend pretty heavily with some leverage, 25 billion with leverage on data centres that will need to be filled with those chips.
So the announcement overnight, if we look at the capacity increase that they talked about, it's actually year-to-date deals that have been announced amount to 100 gigawatts of capacity being added over the next 15 years in data centre gigawatt capacity alone. to give that some context, that is the entire output of Germany today, as far as installed capacity is concerned. And what they announced last night is less than 1% of data center capacity that's been announced of new capacity year to date. So it's a tiny piece of the ocean of a massive build-out spend. Yeah. And obviously, as you mentioned, the memory cycles are very short-dated. The capacity built out for electricity, for power, for AI data centers, unless something happens from left field, then this is a 15-year kind of time horizon that we're talking about here.
Okay. Neil, thank you very much. Always something to talk to you about every morning. Yeah. Neil Campling with thoughts on the tech beat this morning. Let's pivot to the banking sector. Standard Chartered CEO Bill Winters delivering a blunt message on the future of the bank's workforce, warning that a push into artificial intelligence will eliminate thousands of roles as the lender replaces what he calls lower value human capital with technology.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
Bill Winters there. Tom Metcalf, our managing editor of EMEA Finance, joins us now. So talk to us about these comments from the CEO. Tom, lower value human capital. Ooh. That sounds pretty bruising.
Don't we call those people?
Somebody.
I think some people, bankers don't call them people. But,
okay, sorry.
It's lower value human capital. No, I do think those comments, he'll probably look back and think he could have maybe phrased them a bit better. I suspect that's probably going to be a lot of people's takeaway when they read the story is, wow, what a way of phrasing it. But obviously this speaks to, this huge trend going across banking. And I think it's, you've seen it with HSBC. We understand they're looking at, 20,000 jobs. For Standard Chartered, this would be about, in the order of about 8,000. Largely support staff. But, that is the interesting thing. It's kind of really looking to replace a lot of these jobs that are done by humans, obviously with the technology of AI.
OK, people have got an interesting future in this sector. Just in terms of kind of what we're seeing across the industry, how does this tally?
I think 10-15% is sort of what executives are kind of thinking about. That seems to be the baseline in terms of where they're looking to get efficiencies. I think there is a distinction between like the total number of jobs in finance, which may well actually increase, at least in the short term, just because you need different types of expertise. But certainly some kinds of jobs, data entry, anything more routine mechanical, you're going to see that become a much smaller part of the finance workforce.
Do we have any more clarity in terms of the investments that these banking executives are putting into AI? I mean, do we just assume that they're going to be investing more through 2026 into 2027? How much commitment is there? How much ability is there from their boards to back that kind of investment?
Yeah, I think that's exactly the right time frame for, where you'll see that capex increase and you're probably not going to see anything on the bottom line. But no, I think every bank you talk to, AI is, right at the top of their agenda. And I think just institutionally, they're all pushing for this. What's interesting is we're hearing on the regulatory side, there's obviously plenty of concern and, perhaps the sense that maybe the industry is getting ahead of itself, right? Like the technology, is it really there that they can, remove these jobs, remove that human element?
And are we all paying the proper cost of AI when it comes to what is going on here? Look at these companies that are losing money on that story. Tom, thank you very much indeed. What are we going to do next? The EU economy chief, Valdis Dombrovskis, is telling reporters at the G7 conference in Paris it's not time to ease up pressure on Russia. We'll talk about that next. This is Bloomberg.
Happy Tuesday. This is the opening trade. We're 30 minutes into today's session and you are seeing green on the screen. So a little bit of optimism coming through for European equities, building on the gains of yesterday as well, of course. Up 0.5% on the index, the main index, the Stoxx 50, of course. When it comes to the UK, with all the political risk that we continue to factor in, the FTSE 100, despite that, is pushing hard by 0.5%. Some mixed data when it comes to the job story in the UK. The DAX is up strongly, outperforming so far across these indexes, up 0.8%. And this is a point that Guy's been making, is Europe today at least benefiting from the anti-AI trade. Guy?
On that front, I have good news and I have bad news. So let's start with the good news. 4-1, basically the ratio in terms of stock gainers versus losers. So the market is reasonably broad in terms of what we are seeing. The bad news is that actually volumes are a little light today, which maybe tells you there's less conviction in this narrative than maybe we would hope for. Let's talk about some winners and losers. Anna's been talking about Currys all morning. Let's get back in and see exactly how it is doing. It's up by 6.8, doing very nicely. Evolution confirming a buyback out of the Nordics, up 11%. SAP, to Tom's point, the software stocks bouncing back. SAP out of Germany, up by 4%. So there's some good news in this market. Downside, let's talk about where we are seeing some of that this morning. We are seeing ACS. I think it's making an offering. That stock is down on the back of that. Infineon had a good day yesterday. It is down by 2.14%. Chip stocks generally have been a little bit lower around the world, and that is a story you need to fold in there. Glencore's also giving back a little bit of ground. 2.3, that sector under a little bit of pressure this morning, Anna.
Guy, let's get an update on some of the other news flow this morning. The Financial Times is reporting that China's Xi Jinping told Donald Trump that Russian President Vladimir Putin might end up regretting his invasion of Ukraine. According to sources, the comments to Trump came during the summit in Beijing last week. The US is stepping up its response to the Ebola outbreak after a missionary tested positive for the virus in the Democratic Republic of Congo. Washington has now imposed new travel restrictions, and the CDC is expanding its emergency response as concerns grow over the spread of a rare strain of the disease. And European Union officials are meeting today in an effort to finalise legislation for the bloc's trade deal with the United States. Failure to reach an agreement risks missing President Donald Trump's July 4th deadline and could trigger a fresh round of tariff escalation. Tom.
Meanwhile, G7 finance chiefs are meeting in Paris today. OECD Secretary General Mathias Cormann speaking to Bloomberg on the sidelines of the event, saying risks to the global economy have worsened as the conflict in the Middle East drags on.
Normally you would be able to see through an energy price shock, but of course, if it starts contaminating prices more broadly, if you see increases in wages as secondary effects, then central banks will need to take action, even if the economic growth outlook is somewhat weaker. Across advanced economies, what we see is that core inflation remains relatively okay, but of course, that's precisely what we will be looking at.
Well, let's bring in Bloomberg chief Europe economist, correspondent, I should say, and part-time economist as well, Oliver Crook, standing by. Ollie, so you've been talking to leaders there, and notably, of course, the head of the OECD. Interesting talking about the second and third round effects of the impacts of the closure of the Straits of Hormuz. What are you hearing broadly about the concerns, the inflationary aspects and the inflationary concerns emanating from and around what is happening in Iran?
For the officials we're hearing from here, really it's a question of not panicking people, sort of impressing the severity of the crisis, while at the same time saying some things so far, so good. That's what we heard from the French finance minister yesterday when we were speaking yesterday morning. We hear it from Mathias Cormann that they're not quite seeing yet that contagion within the inflation complex back from the headline into the rest of the inflation complex. And that is, of course, the big question for everybody, Tom, is where inflation is going to go. It's not just the quantity of inflation, not just the headline rate, but the quality of inflation, whether it goes into services, whether it goes into wages, food, all the other parts of the inflation complex. And that is really going to be the red alarm for the European central bank governors, many of whom are in attendance here and have been deliberating with the finance ministers to give their sort of appraisal. We should say, though, it is interesting what Mathias Cormann was saying there, that basically, there is a certain point here where the European Central Bank is going to have to face this issue of trading growth for inflation. Which of the two are they going to sort of put the fire out on? And he's saying that effectively you might have to raise rates despite the fact that we're seeing that growth weakening. And that's really going to be the center of the discussion we have a little bit later with two of the governing ECB council members, the Banque de France governor and the president of the Deutsche Bundesbank, who we'll be speaking to a little bit later, to give us a sort of breakdown. What is their read on this inflation? Is it going to remain segregated? And as a consequence, what is the rate path going to be?
Really looking forward to that conversation a little bit later, Ollie. Just give me a status update on the US-EU trade deal.
Yeah, so this is, as we've been talking about for about a year now, and that is, of course, the big frustration for the Trump administration, is that basically you had a handshake deal at Turnberry between Ursula von der Leyen and the United States, and the EU has not ratified the deal. We don't have to go through all the reasons why that is. Of course, it was the Greenland threat. There was the Supreme Court striking it down. But effectively, the Trump administration has now lost patience with the EU, and the fact that this trade deal is not in power yet, is not in force yet. There are deliberations today happening among the European officials and leaders trying to get the legislation sort of finalized. The deadline that the Trump administration has set is July the 4th, the 250th anniversary of the United States, to get this legislation going. And really the discussions today in Brussels among these leaders and among these policymakers is to see if we can get there in time to really make the progress that's required. The EU has added a few more clauses into the deal. The U.S. was not too happy about it, but it seems that they have sort of accepted it. And the question is, can the Europeans move quite fast enough? And that's an answer we'll have a little bit later today to see if they can nail that July 4th deadline.
Absolutely. We'll keep a firm eye on what is happening there. And as you say, Ollie, looking forward to the conversation a little bit later on. We've got an exclusive sit-down with the heads of the central bank from France and from Germany. That is a conversation you do not want to miss.
So they'll certainly be reflecting on higher energy prices. Coming up on the programme, with the global economy wrestling with those higher oil and other energy prices, we will talk to the CEO of Portugal's EDP, one of Europe's largest renewable companies. That's next. This is Bloomberg.
Welcome back. You're watching the opening trade. We are 40 minutes into the equity market session, and thus far it looks fairly good for Europe. We are looking at a picture that is, as you can see, largely green across the screen. You are seeing a bunch of single stocks actually doing fairly well, but there is this kind of anti-AI narrative that maybe is in the trade this morning. Cosby didn't have a good night overnight, and maybe people therefore look towards Europe. That said, some of the software stocks are having a fairly good day today, so maybe that trade coming back into the picture, Tom.
And of course, at the macro level, the global economy, of course, and global companies are still wrestling with higher energy prices. Right now, Brent is actually a little softer, down 1.4% at 110, still $110 a barrel. So the spotlight has shifted, at least to some extent, during this conflict and during what's been happening around the Straits of Hormuz, to what is happening in the renewable space as we look for additional sources of energy. For more on this conversation, let's bring in Miguel D'Andrade, CEO of Portugal's EDP, one of Europe's largest renewable companies. The stock is up about 35% in the last 12 months. Miguel, thank you for joining us.
Thank you.
Around the desk this Tuesday. How has that conflict impacted your business and demand for your energy?
So clearly the impact, of the war in Iran has been very felt on oil and gas in particular. I think in relation to power, what we've seen in some markets, that has obviously had a slight increase in the power prices, but still very, very different from what was the situation back, for example, in the Ukraine crisis back in 2022. So it's order of magnitude different. The TTF now is at around 50 euros per megawatt hour. It used to be sort of 200 plus a couple of years ago. So yes, it's having an impact, but not as much. I just highlight, though, that in markets like, for example, our core markets like Iberia, it's actually having almost no impact. And why? Because we have a lot of renewables, so a lot of wind, a lot of solar batteries. So actually gas is not setting the price, or it's only setting the price for 15% of the hours, which means we actually have not felt the impact, for example, in Portugal and Spain.
Are you hearing more from governments and others about the demand to build more renewable capacity? You've talked about how much there is in Iberia right now. Is there more? Does it change your strategic capex plans? Do you plan to invest more? Are you seeing more of an impulse?
Yes, I think, this is recognized by the President of the European Commission, Ursula von der Leyen, by the Commissioner of Energy, Dan Jurgensen. It's very clear they want Europe to be more energy independent. That means using our own internal resources, whether it's hydro, wind, or solar. So there's a renewed push to be more energy independent.
Fast-tracking licenses?
Fast-tracking licenses, investment in networks, investment in conventional generation. So really trying to push. The only thing I'd say, it's a little bit frustrating because it feels a little bit deja vu versus 2022. And a lot of the recommendations that came out of 2022 still have not been implemented. And now they're giving an additional push. But it's like, we should already have done that.
What are the things that should have happened that didn't?
Well, things like accelerated licensing times, one-stop shops, sort of specific areas where you already have pre-authorization for permitting. So there are some lessons and sort of recommendations that have still not been implemented in many of the member states, going all the way back to 2022. So I think that's been one of the big pushes we've been pushing for.
Meanwhile, the solar build-out in Europe has been quite impressive, and to such an extent that it seems other parts of the infrastructure, Miguel, can't necessarily cope. I was reading colleagues reporting about Spain leading the way in Europe's surge of negative power prices. as there's too much solar power for the grid to cope, for storage to cope. How is that impacting on your business? What can be done to stop that kind of wasted opportunity?
Yeah. So obviously investment in batteries, I think that's one of the key issues. And so what we've been also advocating is to have more capacity payments and sort of making sure that you can actually the build out of batteries. If you look at, for example, Iberia, it's got one of the highest penetration of renewables, but one of the lowest penetration of batteries. And so clearly you need to do more on that front. More investment on networks, so you don't have that curtailment. Sometimes you've got negative prices in some areas, but not in others. And so if you can get that energy to flow, that will also make a big difference.
And this is all your job to do in Portugal? Is this your job and other people's job in Spain? I mean, where's the bottleneck?
So there's a lot on the regulatory side, on the legislative side. I would just add one additional point, which is what we are beginning to see is a lot more demand also coming. And so I think over time, this will be like these cycles. You're having cheap energy now. You're seeing a lot of demand coming in, for example, from data centers and industry that is taking advantage of that. The power prices in Iberia are 20% below the European average. And so as that demand comes in, you'll sort of see that convergence also of supply and demand.
So are you an AI stock? Should I think about AI, you as being an AI stock?
So the AI is clear our largest customers. Amazon is our largest customer globally, Microsoft number 2. So all of these guys are the ones that are buying big amounts of power
So
from
corporate power purchase agreements, how big a part of your business going forward is that going to be?
So it's a huge part of our renewable business. 60% of our power of the projects that we are sort of building and selling are having these corporate power purchase agreements. And the remaining 40 is to utilities that are themselves then having sort of this increase in demand from data centers, AI.
So the extra demand is coming from AI?
It's a huge amount of it. It's not the only thing. For example, in Iberia, you're also having increasing population, electrification, heat pumps, electrical vehicles. So all of that is driving demand. Portugal's had one of the highest demand growths in Europe over the last couple of years.
There was obviously the issue of the blackout.
Yep.
I'm assuming that when you sign these contracts, you are guaranteeing that there's enough. The flywheel effect in the system to keep you at 50 hertz is there. That you can can you guarantee that now?
Well, when you sign these contracts, you're signing it's pay as produced. So as long as you're producing, if there was some sort of.
But are we past that?
I think we're past that. I mean, that was clearly a very exceptional issue that happened in Spain. It was over sort of voltage charge. But I think people are managing the network in a much more prudent way now, and so I think the risk is obviously much reduced.
Okay.
Just another on the data center demand. Where do you see that demand growth? How do you see that demand growth evolving in the years ahead? Are we getting close to peak demand? Where are we in that story, in that journey? And does the infrastructure, does the grid have capacity to meet that demand?
So in the US, undoubtedly, this is one of the best times. You know, we've been investing in the US now for 20 years, and this is one of the best times to be investing there. I mean, we're seeing huge amount of demand driven by, as I say, these big tech just taking sort of all of our projects. In Europe, in particular in the markets like Iberia, Portugal, you're seeing a huge amount of demand also coming online. I normally mention one of these data points, but just one of the data centers that's being built south of Lisbon is going to represent 20% of Portugal's consumption. And so there are many others.
So 20%?
20%.
One data center?
One data center. And there's several others that have requested connections. So we're talking about structurally huge amount of demand.
Can the region build all the data centers that are being that it could build at the moment? Are you turning business away because they cannot be built and connected to the grid?
The way we've positioned it, we want to be part of the solution. So investing in the networks, investing in the generation to make sure that we can incorporate all of that demand. But there is a huge amount of demand that wants to connect.
Is there pushback? Are you facing pushback? I mean, we've seen Portugal's government announce plans for a windfall tax on energy companies. Maybe that's not just oil and gas. Maybe that's renewables as well. And are you seeing pushback from communities affected by data centers? We've seen a bit of that in the US.
Yeah. On the windfall tax, we don't believe it's directed at the power sector. As I say, the power prices are well below the European average, and so I think it's more tailored to the oil and gas sector. In terms of pushback from the communities, I think that's one of the points. We need to make sure that we are bringing the communities along with us, that they see job creation, that they see, cheap power prices.
Is there job creation? Because a lot of the AI story we've been covering this morning is about jobs going away. So that would be a positive.
I think if you think about it sort of in at least where those are located, you're going to have a lot of construction jobs. You're going to have, obviously, people working in the data centers. I think one of the Portuguese government's focus, and rightly so, has been it can't just be about building the warehouse for the data centers. Like, they have to bring additional value added to the local communities, whether it's in terms of high tech or, R&D centers. It has to add something to the local community.
Okay, thanks very much, Miguel. Really good to see you. Thanks
Thank
for stopping by. Miguel Stilwell d'Andrade, the CEO of EDP. We've been talking there about oil prices, and earlier oil prices fell after President Trump said he'd called off a strike on Iran that apparently had been planned for today, following appeal from Gulf allies. For more, we're joined now by our Middle East energy reporter, Anthony De Paula. Good morning to you, Anthony. So how are oil traders viewing these comments from President Trump? We saw oil prices retreat, then they kind of came back to the flat line. I see they're retreating once again. It's been a volatile 24 hours.
Yeah, good morning. Of course, when there's comments like this, when Trump says he's averted an attack, that is going to cool off the oil prices as some of that risk, that immediate risk, goes out of the market. Of course, we're still around $110 a barrel, which is not the highs that we had earlier in the conflict, but it's not really low either. So there is some of that threat still in there. The main point is that we still have Hormuz shut. And so that's what's supporting the market, that we don't have the flows that we need of oil getting out of the market. Obviously, good news in the immediate that these attacks were diverted, but we have a long way to go in terms of the diplomacy around that. The sticking point at the moment is the opening of the Strait of Hormuz. Iran wants the U.S. to take its blockade off of the spot where it has it south of Hormuz. So they want to take that blockade off. The U.S. for its part, wants to get Iran to open it up, have a free flow of crude and products out of the region, in order for the parties then to talk about what they might talk about in a future set of negotiations around the nuclear. So there's a lot of heavy lifting to do there before they do get Hormuz open again, and I think that's one of the things that the market is watching. If they can't reach an agreement around that, then does the U.S. return to the military threat? There are still a lot of military assets in the region. We did see over the weekend the USS Ford has returned to base in the U.S. in Virginia, but we've still got lots of assets, aircraft carriers, Marines in the region. So if Trump wants to act, he might see that as a tool, and as a tool that can't stay in the Gulf forever. So that's going to keep some of that support under oil prices, even though we do see that easing with those comments that Trump made earlier today, Anna.
And Anthony, in the meantime, the US has extended these sanction waivers for Russian oil. How much of a gift is that to Putin?
Yeah, well, that's certainly helpful to Putin. It is going to increase the income, and we are at the income where these prices are very high. The Secretary of Treasury, the last time that the U.S. eased those sanctions, tried to make the argument that by releasing those barrels into the market, by allowing them to be freely traded, that would bring the overall price down so that the Russians wouldn't be getting a higher price and a higher premium because prices in the market would be even more elevated than they were. So that's a little bit of a difficult argument to kind of get your head around. The point is that we are at $110 a barrel, and Russia will be able to sell those barrels for an extended period of time. That's probably going to be helping a big customer like India, which had been using a lot of Russian oil. They didn't really make much of an uptake of the Iranian oil when sanctions on those barrels were lifted, but they have been using the Russian, so they're used to that. They would be happy to get back in that. So that's going to help one of those big producers like India, which has really been suffering as well because of the cut off of Hormuz and the stop of the flow of crude and other products coming out of the Gulf, Tom.
Okay, Anthony De Paula, thank you very much indeed for that update. Here's what else we are going to be watching throughout the day. 9:10 UK time. So coming up, the Bank of England's Sarah Breeden will be speaking at City Week as traders price in more than 2 hikes from the BOE this year. G7 finance ministers, meanwhile, continue to meet in Paris. We're on the ground for you there. And Russia's president, Vladimir Putin, is travelling to Beijing. And after market, we're going to get Euronext earnings results. Plus, in the US, numbers out of Home Depot.
So European stocks this morning outperforming. Will it last? Let me ask that question to Adam Linton, sitting next to me. You're not convinced?
No, not massively convinced. I mean, if you look at kind of the broad equity setup that we're seeing today, we're seeing a bit of froth taken out of the markets in certain areas. You look at the Kospi, you look at the TAIEX and this broader kind of AI theme with, these higher yields acting as kind of a bit of a catalyst. But there's no real kind of massive AI negative catalyst that we're seeing at the moment. I think, Mark made the point, we may get this AI earnings rug pull at some point, but we're not really kind of there at the moment. So, often, spoke about, the lack of tech sector in Europe hamstring its performance relative to Asia, relative to the US. So today things look relatively better on a short-term basis. But the thing is, relative and short-term. Ultimately, what is the backdrop for Europe at the moment? ECB are going to be tightening into a growth slowdown, and if you look at the pockets of strength which drew European equity performance last year, it was financials. Well, performance is flatlined. Yes, we could be in a higher rate environment, but lower credit quality, economic slowdown, and then industrials as well. They're burdened with the prospect of higher energy costs and supply chain disruptions.
I want to ask you about bond markets, Adam, and what's happening there. Because, of course, we tie this all back to Iran because they're an inability to get the energy that the world needs out of the Strait of Hormuz. But today, oil prices are weaker. But we have quite a disparate picture coming through on bond markets today, as if we're sort of pausing for breath after the sell-off that we've seen. JGB's telling us one story with higher yields. The European story is different with lower yields. And in the midst of that, the US yields are sort of edging a little higher. I mean, where are we in this story?
Yeah, I mean, big picture, obviously, it's all about Iran, right? And we saw, that kind of bit of reprieve from that Trump not, escalating things yesterday. But for me, that's kind of a bit of a non-development. We weren't really bracing for it. So the fact it doesn't happen isn't, a massive source of relief. The key story is we saw negotiations yesterday completely at a deadlock. The US is rejecting, the overtures from Iran. The US isn't giving them any relief on oil. Meanwhile, the Strait of Hormuz remains blocked. And, I've got Brent at 110. Risks still remain to the upside, in my view. And then, the US rates space that's playing a bit of a catch-up. We've talked about this inflation angst is creeping in. But I think in terms of what to look out for the bond market, I think the most interesting thing I've seen in the last 24 hours is the RBA. So they were quick out the gates when it came to tightening policy in the wake of the crisis. They've hiked policy, I think, about 3 times this year, and yet they're still concerned about inflation and expectations being de-anchored. So if they're the first out the gate, they're ahead of the curve, and they're still concerned, then for those that are quote unquote behind the curve, that's a real source of concern, and that can make its way felt throughout the back end of the yields curve, which there's some idiosyncratic risk in Japan, in the UK, and I think that's what we should be watching out for now.
Okay. MLive's strategist, Adam Linton. Adam, thank you very much indeed on what to focus in on today. Tomorrow, of course, we have NVIDIA earnings as well, so that could prove to be a catalyst. Maybe that revives the semiconductor
Recent history suggests that it won't. Recent history
because expectations are so stretched.
It's earnings day is a tough day for NVIDIA, weirdly. You would have thought it would be amazing.
It doesn't tell you the story, doesn't necessarily. Precisely. The way the share price reacts isn't necessarily where it ends up days later. I mean, we've already heard from Johnson and Tom this week, haven't we?
Multiple times.
US futures have turned around moderately.
Yeah.
S&P
well,
is up at 10%,
weren't they?
So there's a bit of a turnaround there with European markets up. Currently 9/10%, a decent day for European stocks. That's it for the opening trade. The Pulse is up next. This is Bloomberg.